So the big question is this: how do real estate investors who don't have a ton of free time, don't have access to off-market deals, and didn't start life on third base, how do we conservatively grow our real estate business to support our families, finally leave the corporate rat race, and build a legacy? That is the question, and this podcast will give you the answers. I'm Ed Matthews, and this is Real Estate Underground. Greetings and salutations, Real Estate Undergrounders. This is Ed Matthews with the Real Estate Underground podcast. Thank you so much for joining us today. So today is OG day in real estate world. I am joined by a gentleman who has been there, done that across multiple asset classes, multifamily, senior living, hospitality. The list is actually quite extensive, and it is an honor to have Christopher Finlay on the show today from Lloyd Jones. So Christopher, thank you very much for joining us today. It's good to see you, sir.
Thank you, Ed. Glad to be on.
Yeah. So for those of us who don't follow Lloyd Jones and may not know who you are, why don't you give us a little bit on who you are and how you got here?
Sure. Well, we're a real estate investment firm. We have a number of verticals that are wholly owned subsidiaries. And, we are investing in multifamily, senior housing, hotels, and we also have a development arm and a construction arm and a senior housing operating arm. So all of those are under the umbrella of Lloyd Jones.
Excellent. And so it keeps you rather busy, you and your team rather busy.
To say the least.
Yeah. So let me ask you, obviously you were a commercial pilot, if I remember correctly, right?
Right. Exactly.
Eastern. Yeah.
Yeah.
And so, obviously that takes a high level of intellect and also an even keel from a personality perspective, you'd hope, right? So somebody like me, who tends to be a little more mercurial, is probably not cut out to be a pilot, but, thankfully there are people like you out there. In terms of choosing real estate, right? Obviously you could do anything. And so I'm curious, why real estate? Why did you choose this world?
Yeah, my father-in-law was in real estate, so I got exposed to it through him, and then I started making an investment with him, and I got the bug, so to speak.
Oh yeah,
and the unique thing is we were living in Connecticut at the time, and I was flying out of LaGuardia and Kennedy, and I fortunately in those days you could fly 2 days a week and cover your full allotment. So you really have 5 days a week off. And somebody suggested I should go work with this brokerage firm called William Pitt. You may have heard of them.
Sure.
Down in Fairfield County. Well, I worked in their commercial group as a broker for, a year and a half, 2 years before we moved up to New Hampshire and started our own. So it was an opportunity. I did both. I was flying on the weekends and I was a broker during the week learning the business.
Excellent. Well, that's a heck of a life. You were seeing the world to a certain extent, right? As much as it's always funny. I used to travel for my own job. I was in technology and, my kids always thought, wow, you see the world, you eat at fancy restaurants and amazing hotels. And I'm like, most of my nights, kids are sitting at the end of a bed, eating a quesadilla that I got from the hotel commissary. And it's at a Courtyard Marriott somewhere in the world. This is not my life wasn't humorous. So, but you see movies like Catch Me If You Can or, some of those other movies and you think, wow, what a life that was, right?
Yeah. It was pretty good. I got to say.
Yeah. That's
in those days.
Yeah, absolutely. Yeah. The world's changed about 10 times since then, right? So let's talk about the focus in terms of the various divisions. I'd love to unpack, multifamily, and we can get into senior living and hotels as well. But I'm curious about multifamily. One of the things when I was doing my homework for this, a theme kind of jumped out at me that, and you actually explicitly say something to this effect in some of your marketing materials that, you're not too concerned about the ebbs and flows of the economy or, and I talk about that in terms of recession, non-recession, but also, low interest rate, high interest rate, historic interest rates. And so I'm curious if you can share with us your philosophy on the business in terms of timing the market, and also, in terms of how you look at, the current state of affairs and where we are today.
Sure. Look, in my opinion, we got into investing in multifamily in a big way in 2010 and just rode the wave, right? It just was an amazing time. You had a big demographic tailwind involved here, which were the millennials that were feeding that demand factor. And there was an undersupply in 2010. So it just never caught up, and it allowed for prices to just, continue to rise. And, I think that's peaked. Quite frankly, I think, we saw 21 when rents were going up 2% a month and going crazy. And, you could sell a C plus property at a 3.5 cap in Florida. I said, hey, I've been here before, so I gave the order to sell everything in our entire portfolio. And we ended up selling about 80% of it. The other 20, we had it under contract, but people tried to retrade me. And I said, no, I'm not, I'm not doing it. Stupid me, because, now it's for 20% less. But anyway, I think the cycles, you see cycles coming through. And I think, demographics is a big thing to me. I think, and look, there's still an undersupply in multifamily, although there's a huge number of apartments being built now and so forth. But this will get flushed out the next 2 or 3 years, and then multi will, start coming back. And, it's always a great asset class. If you're a long-term holder and, you don't over leverage on these, and you have a good capability of either asset managing or managing, multi's just a phenomenal asset for a very long time. You may have some ups and downs, but even the downs are pretty shallow in multifamily compared to a lot of other classes. So still a fabulous asset. We're now focused on senior housing. And the reason for that is even prior to COVID, there was starting to be an opportunity there. It was a little overbuilt, the 2018, 2019 market. They overbuilt it. It was starting to get soft. And, we felt that there's a huge baby boomer generation coming along that's going to be massive.
Yep.
Yeah, massive. And so, we thought 2020, we're going to get into this in a big way. And then COVID hit. Thank goodness we hadn't bought anything, and we sat on our hands focused on multi. But then, when it got at the end of COVID, 2021 and 22, we just saw some great opportunities to buy because COVID really decimated the whole industry. Yeah. And you could have been the best in the world or the worst in the world. You uniformly got clobbered, just beyond anything anybody could handle. So those assets are now, being sold. And we just feel it's just an unbelievable time to enter that market. And we think I tell people it's multifamily 2010. You could go back and buy a nice B apartment at an 8.5 cap. Well, we can buy a very nice senior housing at an 8.5 cap. So, it's just a pretty good, strategy as far as we're concerned anyway.
You, sir, have my attention. 8 caps. What's that?
Yeah.
It's interesting. I'm curious what your take is on the interest rates and where they sit now relative to history, historical numbers.
Yeah, well, that's a great question. When I opened my business in 1980, the prime was 19.5%. 19.5, Ed. So, it's, hey, look, interest rates are up there, but they're still not, on a historical basis, they're not crazy. They're high, but, look, I think we all realize we're getting towards the end of this. And there's going to be a couple more hikes, in my opinion. Yeah. But look, I think we're getting close to the end. And if you buy a floating rate, get a floating rate deal, you run it down and you instantly make money on the down track. So I think interest rates factor in. And, I tell our guys, it's part of your underwriting, right? You need to be able to buy the asset to be able to support the debt. And there's a number at which it supports the debt if it's at 7% or 8%. And there's a number it supports the debt if it's 4%. So it's really a price adjustment, right? And so you make your decision to buy based on what gives you a reasonable return at today's interest rate, or you don't buy.
I had this conversation. So we're very active in the market here in Connecticut. And I have this conversation at least once a week with a seller who, is hanging a, 2021 price and ignoring the fact that it's 2023 and that the interest rate has gone from, prime, base interest rates have gone from, 3.5 to 7, 6.5 to 7, right?
All right.
And so, the conversation goes something like, I am happy to pay the price you're asking if you give me terms that also reflect 2021 terms, right? If you're going to allow me to acquire the property at 3.5%, happy to do it. But, if my cost of capital is 6.5 and, you're asking for a, 4 or 5 cap in terms of price, that math doesn't work.
Yeah, 100%. Yeah. So it's really a price adjustment. And I think that's where you see the I just read a report where I think in May, multifamily sales were off like 70%. And I think it's just, the adjustment hasn't been made. Everybody's waiting for it to be made. So, everybody thinks sooner or later there's going to be an adjustment to the pricing, but it hasn't been made. So you're dead on.
Yeah. And I think the bridge loan situation is going to have a pretty big impact on this as well, right? I saw a report, I've mentioned this in previous episodes, but I saw a report from Moody's that 23 or so % of the adjustable rate mortgages that are being repriced or need to be repriced this year won't be because, obviously they don't pencil anymore.
Correct. That's where the adjustment's going to happen, I think, over the next 12, 18 months. I think there's going to be a big adjustment and people get to the end of that loan and try to refinance it.
So I want a couple more questions about multi, and then I want to talk about senior living. As far as multi goes, when you acquire them, you are managing them yourselves as Lloyd Jones, correct? You don't hire local property managers.
Well, we did initially do it all ourselves.
Okay.
And so, when we were building the portfolio, subsequent to selling off 80% of our portfolio, we decided to put it out to, outside management. I think it's very difficult to, manage a property, as a small outfit. I think the smartest thing you can do is find the best manager in that market and then intensively manage the manager. And that means, being on the property, inspecting the property, going over the financials with the manager on a monthly basis, interrogating every line item, just micromanaging the manager. I think that's the best. When you get bigger, I'd say like 1,000 units, then it may make sense to start your own management arm. But let me tell you, it's very difficult. Managing is a hard business.
Yeah, it's, we actually have so I'm well below 1,000 units and we manage our own properties today and we figured it out, but there's a reason why I have gray hair on both sides of it, just because I'm a, father of 2 teenage daughters. So,
there's advantages to that. You control the whole thing. And let's face it, it's your dollars. And chances are you manage it more cost effectively than a third party manages it.
I'd like to
without a doubt.
Yeah.
So, you carry your heart's into it. And so that's, if you have the time, the capability to do that, it may make sense. But, it's a very tough business.
Stay with us. We'll be right back.
A motivated seller just filled out your web form. If you call back within 5 minutes, you're nearly 4 times more likely to get that seller appointment. But delay your follow-up by even just 10 minutes? Forget it. You're toast. Ella Vista Connect calls that lead back in 60 seconds, qualifies them, and schedules your meeting. Find out how much slow follow-up is costing you. Free calculator at ellavista.com/underground.
It is indeed. So let's take that and talk about senior living now. Now, you mentioned that you have a management company or an operating company that operates you. Now, do you just operate your properties or do you do this on a third-party basis as well?
We do both, yeah. And the reason why we've so heavily invested in, we have about 1,500 units of seniors currently, which is, small. But the senior housing business is 95% management and operation. So, there's a real estate investment component of it, of course, but you make it or break it on your operations. And the operations are even more intensive than hotel operations. It's 24/7. You've got, all sorts of staff there. 100-unit property could have over 100 employees.
Right.
It's just a huge operating business, and that's what the focus has to be. So we felt we're going to get into it, even though we only own a few hundred. It's time to get in there and manage it yourself and be hands-on and create the brand strategy that you want to put on that asset. It's very important to that. It's the key. The operations are key to the business.
Well, yeah. The fact is, I would imagine, having some folks in my family who've moved into senior living over the years, brand is enormous, right? The customer experience, it's, if I learned anything about that business, and I don't know a lot about it, to be honest, the experience of your residents basically sells the next generation of residents, right? My mother-in-law and father-in-law giving tours of their own unit and talking about what it was like to live in the place that they were living, and it was, I'm sure there was a sales process as well, but I think the thing that typically drove it home for prospective residents was the experience that your current residents.
100%. Yeah. And that just, produces a reputation for the whole property.
Sure. Absolutely. And so now, are you developing these properties? Are you acquiring these properties? Both?
Yeah, well, we started a development actually in 21 one senior facility. It's an independent living, high-end, Port St. Lucie, Florida. And it's really great. It'll be completed in about 6 months, and 160 unit property, really gorgeous property. So we've done that. But, subsequent to COVID or after COVID, there's such great buys that even we can buy new properties well below replacement. So, so it doesn't make sense for me to build when I can buy.
It's too expensive, right? Why would you?
Exactly. At 75 cents on the dollar, I can get a brand new property, and all the risk of development goes away. And, development's a very high risk business.
Yeah, it is. It is not for the faint of heart, so they say, so to speak. And so in terms of your senior living business, obviously baby boomers, 76 million people, it's the single largest transfer of wealth in human history, which says a lot. And I'm curious, in terms of the market size, obviously all 76 million, you're not going to move into senior housing. And, so I'm curious, how do you look at a market and quantify, okay, I know what the population is, and, how do you look at the demographics of an area and decide, okay, this is a place where I want to acquire a property? It's obviously very different from the multifamily world, because guys like me are looking at job growth and diversity of employers and, obviously net median income, both for individuals and families and things like that. But that's probably not what you're looking at, right?
No, there's great demographic information out there, and you do your study based on a 3 and a 5 mile radius. So these people, really generate very local. It's very local. Now, as part of the study, you're also measuring, the 45 to 55-year-old population.
Yeah.
And what their income stream is, because chances are when mom and dad get really, older and need to be close, they want to be close to you.
Sure.
It's either you move to them, but chances are you have a job. So they move close to you to be near you and near the grandchildren and so forth. So that's part of the demographics that you study. But you have, the independent category is usually 75 to 80. And then assisted living memory care is 80 plus. And there's demographic studies you can get. And then you really are basing this off of a very slim percentage, because everything we do is private pay. And so, you have to have, the wherewithal financially,
right,
to be able to afford this. And then you also look at the kids and that demographic and see what the income is for your market in that demographic, so that there's children that can help pay. And, and that's part of the research and the study you do on what market you want to be in.
Yeah. And so taking it one step further, the kids, the 45 to 55-year-olds, they're also your future customers, right?
Correct. Down the road. Right.
Right.
Exactly.
So, not only do they need the wherewithal to help mom and dad, but they need the wherewithal to help themselves.
Right. Yeah. Correct.
Okay.
Yeah, correct. And you referenced the baby boomers. The baby boomers, I think I read somewhere, it's going to be like a $60 trillion transfer of wealth or something like that. A trillion. It is just
a massive amount.
Huge, unbelievable, massive transfer of wealth from that generation to the next. So
this world won't look the same 25 years from now. But you could say that of 25 years ago as well. So
yeah. Exactly.
You and I haven't changed a bit in those 25 years, but the world around us changed quite a bit. So, and so when you look at a senior living, so you are not, it's obviously, in part, it's a multifamily, right? You're providing housing, but it's also a medical facility, yes?
Correct. Yeah. It's a care facility. It's not a medical facility. So, we're providing basically ADRs, which are assistance in daily activities. And so it's not that we can, do medical procedures or that kind of stuff. None of that, but just, you just help with their lifestyle, help them and keep them healthy.
Now, do all of your facilities have that kind of next level of care? You mentioned memory care, for instance.
Yeah. Most of the facilities we buy are assisted and memory care.
Okay.
Sometimes they include all three: independent, assisted, and memory. And that's a nice concept, but I would say probably 80% of our assets are assisted living and memory care. And memory care, is becoming more and more, they're full. They're, tragically.
It's interesting. Here in Connecticut, there is a lot of independent and assisted living, but the memory care, that next level here is, for whatever reason, is very hard to find.
Yeah. In a lot of places.
Yeah. Yep. And so, when you look at So when you invest in senior housing, is it the same model, everywhere where you're going to provide assisted and memory care, that next level, or does it depend on the demographics of the area?
Yeah, no, well, we're buying existing. So if it has an existing assisted memory care, we would do that. Sometimes we have land next to it that comes with the deal. We might put an independent living next door, so to speak, and that's a really nice concept. So, but we normally, it's normally pretty much what we buy.
Right.
And that's licensed too. These facilities are licensed.
Yeah, thank God.
So, yeah, exactly. And you have to have a licensed administrator running them. So, the executive director of each one of these facilities has a license.
Yeah, excellent. And so we're coming up on the last lap of this conversation. So I want to bring you into the final four. And these are four loaded questions, and I can't wait to hear how you answer them. So, Chris, in terms of your experience, obviously you've been a mentor to many people, but I'm sure you had mentors along the way. And so I'm curious about the best advice you ever got and who gave it to you.
It was probably Bill Pitt, who was, William Pitt, who founded that company. And his feeling was, always be cautious about leverage. Back in the days when, after the 2008 meltdown, I think everybody got the lesson that it's not too wise to get 95% financing, right? So in those days, it was just loaded on.
Right.
So, so you really have to, I think, be careful and not over leverage your property. That's because if you can hold the asset and not lose it in a down market, it's coming back. And it's going to come back stronger and be worth more than it ever was before, even at the peak before. So be prepared to weather the storm. If you weather the storm, you're coming out fine and you're going to make money. But if you lose it, you've lost everything.
Indeed. And I know plenty of people that did. So I'm curious, when you talk about leverage, obviously a standard in my world is, well, most people say 20% or 80-20 loan to value. I'm more of a 65-70 kind of guy. I'm curious about, your operation and your view on leverage. What do you look for in a deal when you're, I know I know you've got a senior note coming up. So I'm just curious, what do you look for in terms of loan to value or loan to cost?
Yeah, we're seldom above 65. It's, now when we did multi, we may have gotten up as high as 70 on Fannie, but we never layered on additional, mezzanine financing or preferred equity or anything else to get it, push it up there. So most of our multi was Fannie or Freddie. They're usually at 65, sometimes a little higher, maybe 68. And now what we're doing as well as, maybe 60, 65 range with pure equity above that. So, so that's what we think is a reasonable number today. And especially at these rates.
Yeah. And it's certainly going to support your cash flow, right? Even if cash flow takes a nosedive, like you said earlier, you'll weather it just fine. Very smart. Very smart. Okay. So I see that bookshelf behind you. If for those of you who are listening to this, Chris is sitting in front of a gigantic shelving unit of books. So, I'm always curious, leaders are typically readers, right? And, these days that can be audiobooks or physical books like the ones behind you and the ones scattered around my office here, but also, YouTube videos and podcasts and, seminars and webinars and all that. So I'm curious about two things. One is, how do you sharpen the saw? How do you take in information? And then I'm also curious about, who are you paying attention to these days? Who are you reading?
Yeah. So I'm a reader. I love to read, and I probably read at least 2 books a week. So, and there's 1,000 books here, by the way, over 1,000. So I really enjoy reading, and I like the hard copy best. I take my Kindle on trips, of course, but I love I read a book recently. I know you mentioned this question. The book is called Your Next 5 Moves, and it's by an English gentleman called Patrick Bet David, and it's a really great book. It's a down-to-earth, good advice that is some of these books just get so over the top and so complex, and this is just down-to-earth, great strategy and advice. So so that's a great book. But I love to read. I look at videos. I watch some videos. Sequoia, which is the venture capital firm.
Sure. Yeah.
They do a great job of putting out information and on the economy and what they see coming down the pike. They were the first, in my opinion, to call what was going to happen at COVID. And I don't know I think that was a result of they probably had a lot of investments in China. And so they got a hint of what is happening before we did. But they warned all of their startups to go into a very defensive mode way before everybody else. And I read that memo and I thought, wow, these guys are being really extreme. So I sent it to my son and he read it. He said, I think they're dead on. I'm going to do exactly what they said. So, they were ahead of the pack for doing that. So that's to me, one of the best newsletters out there, and then Howard Marks, he's another great commentator on the economy business. So, but I love to read.
Well, there's a gold nugget for me. I did not occur to me to look at Sequoia and their newsletter. That's absolutely brilliant. So let me ask you this. Here's the big loaded question. If you had to start over, what would you do differently, if anything?
Wow, that's a tough question. We grew, during the boom cycles, we grew pretty fast and rapidly. We grew by recruiting a lot of young kids out of college. So we hired a bunch of young people and trained them. And, that was great for them. Most of them last about 2-3 years, then they go up. I feel good about it, quite honestly, because I feel like, hey, I've done something good for them and they've moved on. And these guys are, leaders and done tremendous. So, that's a good thing. But I think when you're building a business, especially a small business, be careful about how many junior people you have because they can consume a lot of time, a lot of money, and a lot of effort. So,
and then they're gone.
Yeah, exactly. Yeah. So if I had to do it over again, I think I would probably operate with a very lean but elite team of top players. And, you pay a lot more for them, but they don't need any hand-holding. They don't need training. And,
and they stay
exactly. So that's the lesson I learned.
All right. Well, noted. So, Chris, I'm curious about your personal life. When you're not in real estate mode, what do you do for fun?
Well, I have a bunch of grandchildren. I have 8. I love to go see them. Love to go watch their games and visit them in colleges and stuff. And so it's a lot of fun to travel all over the darn country, from Wisconsin to New Jersey to Rhode Island, you name it. We've been there. So it's an awful lot of fun. When you become a grandfather, then you're living life. Let me tell you.
Someday. I keep telling my daughters, I have a 20-year-old and a 15-year-old. So I say, it's not a race. It's not a race. I'm happy to be right now my 20-year-old has a dog. And so I'm a dog grandfather and that's fine. Perfect.
Yeah, absolutely. Yeah, absolutely.
So Chris, I've really enjoyed our conversation today. Thank you again for, carving out some time in your very busy schedule. If people want to learn more about Lloyd Jones or you or the offering that you have coming up, what's the best way to get a hold of you?
Sure. It's LlyodJonesLLC.com. And that puts you right on our website and everything's there.
All right. Well, Christopher Finlay, thank you so much. It's a pleasure to see you and speak with you. And once again, I appreciate your time and your willingness to offer your experiences.
Hey, my pleasure. And thank you very much, Ed. Great chatting with you.
Likewise. Thank you. This has been the Real Estate Underground podcast. Thank you so much for listening. Don't forget to rate, review, and subscribe. It helps us grow. Until next time, happy investing. This has been the Real Estate Underground. Don't forget to subscribe. It helps us grow. Until next time, Undergrounders, remember your real estate journey begins with a simple step forward. Now get to it. Bye for now.